Hi, I'm Peter Rose, founder of Longwood Currency Trading. Don't try to fade the Forex market. It's not going to work. It's not going to happen. Short story about actually something this morning. I got up, went down, looked at the trading platform, and things were moving, and there was a strong downward action in the market that had occurred a couple hours before I got up and got down there. 123 pip 1 hour bar on a pair that usually has right now about around an 80 to 90 pip daily ATR. We got 123 pip 1 hour bar. So there was a reaction to that bar of about 50 or so pips, and that had straggled along for a while and was now turning down into a downward movement. So my thesis on the thing is there had been this radical drop, there had been a retracement, and now it was dropping again. And I thought, well, if it drops a certain part further, it could pick up some of this continuing downward trend that was established by this 123 pip 1 hour bar. So there's a lot of selling pressure in the market right now for that particular pair. So maybe I could pick up on the draft on that and just ride that down. Now, the major trend over a daily chart is more up. A 50-period moving average is upward. But the 1 hour and even the 4 hour charts were flatlined to slightly up. So I thought, well, I could catch a quick fade on this. I could run that. So I set a couple of limit orders and went off and got coffee and all that other kind of stuff and came back, and there had been a 60 pip rise in the price as opposed to the drop that I had anticipated happening. And I wasn't looking for 40 pips or anything. I was just going to grab it 8 pips and be out, because I knew that there was a lot of volatility going on, and just thought I'd catch a quick draft. I'd fade it for just a little bit. In any event, I didn't. The limit orders weren't hit. It ran 50 pips up, and it's kept running up. I'm looking at that thing right now, and it's gone up another 20 pips. So I missed that trade. But not only did I miss that trade, I'm not going to try to fade that market again. The theory that I had, the premise that I based my limit orders on, did not fulfill itself. And it didn't have to go 50 pips against me not to fulfill itself. It was either going to take my order right away and I'd be good, or it was not going to do anything and stay there, in which case I would have just canceled the limit orders, or it would have gone up, which it did, and it went up dramatically beyond where it was. So here's the fade, the real fade part. I could look at that price and say, oh, well, this downward pressure has been an anomaly, and we're going to regain the daily trend, which is upward, and so I'll go and I'll spike in a long position on a couple of pending orders, or maybe I'll just click market and go. I could fade that big downward pressured movement by going up. Or I could say, hey, I was right the first time, I just was at the wrong time to get it. So now what I'll do cleverly is I still think it's going to go down, and so I will move my limit sell order up, so that as the new trend fails and rolls over, I'll catch that 40 or 50 pips on a downward play. I'll get double my money. No. You know what I did? Closed out, walked away. I'm not going to fade the market. The violent reactions are caused by some economic news release that came out. Usually those things are short-lived. And so if you have a price that over the long run, the last 50 periods on a daily, have sort of been going up, and even the 20 is going up, and you get this massive movement downward, regardless of what caused that, and there are economic conditions. I came in and then looked at the news to see what was going on. Oh yeah, the thing that I saw yesterday, that's manifested itself in the markets. Stock market will be up crazy, and I'm looking at the currency market, and it's reacting that way as well. So the tendency as a day trader to get too focused on that smaller time frame, and when it doesn't go in your favor, that you double down and go back in and try to catch it after it's moved against you, thinking it's going to come around and go in the direction that you thought that it was going to go in. You can't think. You have to go on probabilities. So, and that's what I do. I had a probabilistic opportunity that the price would continue in a downward direction, and I would catch just a few pips just so as not to try to be a pig about it. But if it wasn't going to go and it was going to go up, I didn't want to try to bet in that direction, because that would indicate just in uncertainty in the market in this point, that it's not establishing a new, like a swing point on the upper end at that top of the 123 1-hour bar. That could have been the swing. Well, how do I know that? It just doesn't compute. So the probabilities of it turning around and going in the direction that I thought that it was going to go in, those have vanished. And I'm not even going to think about what the probabilities are of it going up, because I'd already established a bias of what I thought was going to happen based on a probabilistic analysis. So why would I think that if it went way against me, that my original premise was still valid? I would have to do a reanalysis. I don't have to do that. I've got enough experience to know I just didn't get the call right. And if my limit order would have been set incorrectly in an anticipatory manner, that limit order would have been picked up. And instead of grabbing the 8 pips, I could have lost 50 or 60 pips. So, because I walked away to get coffee and let the trade run, because I in my risk management, if that price was going to go down from where it was, if it was going to go down, it was going to go down high probability and take me out, and I'd be done. I'd do this all the time. If it doesn't go down, I don't know what's going to happen, and I don't care what's going to happen. That's why I'm doing this video now, because I don't care what's going to happen. I'm not going to trade in the market unless certain other things happen that are consistent with the conditions that are the foundation of my entry analysis rule. When I work with a student in a fast track program, the reason that I will take a student on is because they've got 6 months to a year of trading in a live account with reasonable leverage, so that you kind of understand the market and you can understand what that fast track program is telling you. It's telling you how to trade. It's not so much the Forex market with the intent. It's trading. Once you learn how to trade, you can trade anything. Cars, currencies, old tires, real estate, doesn't make any difference. Trading is trading. So that's the first thing that I work with a student is, what is trading? What are you trying to do when you trade? You're trying to solve a problem. What's the problem you're trying to solve? What's the market that problem exists in? And how do you simplify that? Because all problems are complicated, but you should be able to simplify those. So by establishing a new foundation, I just did the last video I did was had to do with time management, and the video before that was rebooting your trading to be more consistent. And so the follow-up with that is, don't try to fade the market. When you have good rules, you need to follow those rules. And if the rule says, well, you could try this because it's a high probability that it should work, and then it doesn't work and the price just staggers there for a while or whatever. When I put those limit orders on and went in to get a cup of coffee. The reason I went in to get a cup of coffee was because when I came back, if the order hadn't triggered, I was going to get out. I wasn't going to leave them stand there, because my analysis, when I sit down and evaluate the trading environment, there's one of three questions that I ask. Is there something that I need to do right now? Is there a trade I can get in right now? Market order, bid ask, boom, gone, I'm in. Is there something I maybe not be able to do right now, but does it look like the storm is brewing and that I will have an opportunity at some future point within the next 2 hours in order to take a trade? That's number two. Number three, Jesus, I don't know what's going on here. I'm not going to go on either side of that bid ask. I'm not trading for the day unless the price action completely changes, and then I will do a reanalysis. But that analysis only takes me 15 seconds because I have 4 conditions to my entry analysis rule. If they're not met, I don't take the trade. It's when do you take the trade? So my conditions lay that when part out. This is what the situation needs to be. This is how I would need to resolve that situation, and this is when I do it. So until all those conditions are met, all I can do on that last condition, which is when, is I can perhaps set limit orders to say, well, it's going to move in this direction. I don't know. The probability is that I've established is that it should move in this direction. I don't know when that's going to happen. So when it does happen, it needs to get to this point in order to be confirmed as enough of the validation on the other conditions that would validate a valid actual execution of the limit order. And so when I came back after getting my coffee, it had gone 50 pips in the other direction. But if it hadn't, if it had just been stagnant and just hovering there, I would have canceled those limit orders. If price then would have started down, I would have rebooted my analysis. I would have done the entry analysis again and said, are my conditions being met? Is this a fade? Is the market trying to fade me by moving in a short direction so that I would get enticed back in? Or is this a true movement and I should throw some pending orders on there? Or maybe maybe it's ready to go and I can bid ask with the market. Or is this simply setting up something else? And that's something else I don't know. And there's no way to probabilistically determine what that something else should be or when it would happen or how I would deal with it. And so I walk away. That fast track course makes the assumption that you've got the maturity in your trading to recognize when something isn't going in your favor. The problem that you're probably facing is that you don't believe your own view of what's going on and you don't get out soon enough. Some fool has told you to set a 20 pip or a 30 pip stop because you're looking for a 100 pip gain. I mean, I even on a day trade, there's people out there talking about shit like that. In the event that you are experienced enough to recognize price action and its variabilities, then you're more prone to listen to me when I say you're correct in what the little voice in the back of your head is telling you. This isn't working out. I got to get out of this. Instead, you don't have the confidence in that because you've been listening to all these people out there that are giving you what they can do as your plan, and that's not your plan. Unless you're making job replacement income right now, if you don't have a solid foundation to your trading, you don't really have a plan. And at some point, as lucky as you'll get following someone else's engulfing candle pattern or Bollinger Band or whatever system it is that they're going to tell you how to do, or we're going to compound this in real time. And at some point, the long risk management probability of the overall success or failure will catch up with you, and your account will be gone in 2 or 3 trades. I know this for a fact. I know it from a theoretical process, and I know it from an experiential process. You have to be so alert. Trading currencies is the easiest market to trade if you have some basic skills. You know, sailing a little boat, when I was young, my dad bought a little 12-foot Penguin class sailboat, and we sailed on Lake Michigan. And he taught me how to sail. And it's very difficult to learn how to sail because you get the wind going, and if you get your head up at the wrong time, the boom swings across and bangs you in the head and knock your ass off into the water. I mean, there's all kinds of stuff that can go wrong on a small boat. You tip it over, it's mind-boggling. But if you develop a basic understanding of what makes that boat heel over and how that's an advantage when you want to go fast, but what too much heeling over will be to slow you down because you're spilling the air out of the sail. And so there's a sweet spot there as to how far over you want that boat to heel. There's a methodology to how you pull that mainsail in and out and how you jiggle the rudder to keep the boat close to the wind so you're gaining the maximum effect of the sail form. And then it becomes simple. Sit there, smell the air, and have a good day sailing. And trading should be the same way. You should be able to sit down at the desk and have a good time. Yeah, you're going to lose, but once you understand risk management, which is the first thing that I cover in that fast track program, the way it should be covered in real life, then you don't have any fear of loss because you've accepted the loss that the probability says that you could accept. That probability might be 30%. It might be 40%. If it's more than 40% that you're going to have a loss, then you don't take the trade, right? I mean, you're being taught. I'm teaching you how to look at certain metrics that you develop in your trading, so that they make sense in the big picture. The order flow that's going on. We talk about order flow in a currency market as a representation of the trading, but the trading is the main basis of it. And then you look at the order flow, and the order flow may be different in the market that you're trading. If you're trading Pez dispensers on eBay, order flow is going to be different than if you're selling cars or trading corn or cars or whatever. There are these steps that you go through so that you sit down and you say, there's an implied risk here. I could be wrong. I could be wrong, number one, in my whole premise as to what direction the price is moving in. Or I could be wrong in when I'm reacting to the particular situation. So if your rules don't take care of that for you, then you're left to your own devices in real time to decide what you should do. And because in real time you have so many different things that you can consider, you're probably looking at 15 different things. Somebody taught you about a Bollinger Band and RSI, and you're looking at the fundamentals, and there was an economic release 2 days ago, and it's Tuesday, and now you're up to 6 things. Do you know if you had 5 different things that you were basing your confluence decision on what to do, you'd have 325 different permutations you could arrange those 5 things in. Just having 2 things, you have 4 different permutations you could arrange them in. A and B. I could have A, I could have B, I could have AB or BA. So I'm if you know what my bio is, I've got a bachelor's degree in physics, almost a minor in math. I did 40 years in real estate investment. I think I know a little bit about risk management and trading and finance and stuff. So when you are looking at your trading and you're unwilling to take a course, you need to have these things in the back of your mind that, number one, I don't want to have a whole lot of things in the back of my mind because then I go into a permutation matrix toilet bowl. I'm talking about the things that you consider the indicators, let's call them, that you limit those and base your decisions on the best guesstimate that you can come to, because if you don't understand how to figure really simple probabilities based on the real-time action that's going on the screen at that particular time, not what happened 6 weeks ago with 4 touches to this fucking line, that doesn't mean anything. When you are getting into trading, you're being taught by people who have made, say, $1 million, or they're making $100,000 or $200,000 a year in their trading. Can they relate what they're actually doing to make that money to you so that you can do that? If they're talking about Bollinger Bands and RSI and confluence and engulfing candle patterns, and they're trying to teach you that stuff, then you should flee from that, because that's not how they learned what to do. But because they don't understand the process, the foundation of what they did, they just made a lot of mistakes and all of a sudden got successful. And they see that magically price touches this fucking Fibonacci level. And so they're going to tell you about fib levels as confluence to structure and a Bollinger Band. No, that's not how they trade. That's telling you how they think that they're trading, but that's not really how they're trading. Because if you trade that way, you're going to lose. And since they're not losing, they must not be trading that way. I understand. Who am I to say that? I've been teaching martial arts for over 55 years. That's important stuff to teach. I know how to teach stuff. And so when you are looking at developing your trading plan, look at developing rules that support what you want to do, that are based on reality and not on indicators or whatever. So don't trade don't try to fade the Forex market in your trading, because the tendency for you to do that means that you don't understand the trading itself. Get a good education, whether it's from a book or a course or something that you take. If you have any questions about this stuff, you can send me an email. I'd be happy to chat with you and tell you a little bit about what the Fast Track program is all about. You may not have the experience for it. Maybe I can just point you in another direction so that you can get your foundation of information that you need, what a pip is and how to size your bank and a Bollinger Band, and do some trading for a few months and get some experience behind what you're doing, because then what I have to say will make sense to you. Okay, I'm going to finish my coffee. I did a French press again today, and I didn't lead you through the brewing process. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.